Okay, today I'm going to teach you something called the earnings gap up play. This is one of the easiest moves in the stock market and is one of the moves that can easily move your account up during the year. This is not financial advice, but this is something that I would do if I wanted to increase my stock trading or investment account so that we can get closer to that retirement that we are all hoping for. So as we all know, stocks must report their earnings 4 times every year. And sometimes the news is so promising that investors are actually just throwing money at the stock. And this leads to stocks making moves of about 40% to even 100% in just a few weeks. A few examples were SMCI in May 2023. Here in May 2023, we see that when SMCI reports its earnings, SMCI gaps up. This is because the earnings were so good and promising. And then it proceeds to make a 200% move in just about 93 bars. We have Powell in Feb 2024. You can see that Powell Industries gaps up, goes 45% up in one day. You could have bought it here at $100 and then goes up to $200 in just 4 weeks. Next is Root. It had great earnings. On this day around Feb 2024, you could buy it here on a gap up day. The thing multiplied times 7 in just 2.5 months. So HIMS, we can see that it has had 2 gap ups this year. The first one was just a 40% move that happened in literally about 2 weeks, as we can see. And then there's another gap up here where there's earnings. It does not move on earnings, but just a few days later, it recovers and then does a 60% move in just about 2 weeks. So why do I love this trading setup? The first thing is that it's very easy for both beginners and professionals. And these setups happen very often during the year because there are over 10,000 companies and each of them has to report their earnings 4 times every year. As a trader, my main goal is to make a lot of money when I'm right and to lose very little money when I'm wrong. And this is very hard, as we're going to find out. So the first thing that we have to ask ourselves is, what is a gap up or what is a gap down? A gap is when a stock opens at a different price other than it closed. So we can see here in this company called Fix, the price closes at 152 and in the morning, due to great earnings, it opens at 167 because a lot of people are willing to buy the stock, so they bid up the price. We can see a gap happens again here on a later earnings date. It closes at $247 and then opens at $200. These are what we call gaps. So gaps not only go up, but they also go down. So Palantir, as we can see, gaps up in price here on a good earnings report. And here it also did gap up, but then later in the year, in 2024, we can see that it gapped down because investors did not like the earnings. As soon as it reported earnings, it went down 15%. So that is something that we call a gap down. So what led me to this particular research on earnings, gap ups, and this play? So the first thing that I did was when I was studying stock market winners, I realized that 25% or a quarter of all the biggest moves in the best stocks in the stock market started with a gap up. And so many people out there are very scared to buy a stock when it opens 10% or even 20% above its previous price. But that means that they would miss out on a quarter of the big moves. So I had already started this research in about 2019, but then I was doing penny stocks and I did not get definitive results on how I could buy gap ups until I found a trader called Colin McGee who had been doing this move, and then I got a few tips from him. That is his website, so you should check it out. So in this set of slides, I actually did a lot of research and I expanded on his work, but he found out a lot about the play. And of course, since I don't trust anything on the internet, I started to carry out small tests with my own money. And then this led me to a formula that I'm just going to show you. So the first thing that we have to ask ourselves is, why do stocks normally gap up? Stocks normally gap up because of earnings news. I like earnings news because this is a very repeatable strategy that happens a lot of times during the year. It could be due to mergers and acquisitions, but I did not find consistent results from mergers and acquisitions. It could be due to contracts, deals, or it could be biotech companies releasing a drug. Now, biotech stocks are the most volatile, and I've seen many of them do about 200% a day. But unfortunately, there's so many moves that fizzle out, and I did not find very consistent results. I need to do more research on biotech companies. When gap ups happen, we have three results that can happen. We have stocks that immediately crash in that they go up once they open up 10% during the day, then they immediately crash and they never go above that price that they gapped up on. Then we have a gap up and then a fake move up and then it crashes. So these stocks maybe will open at $100, go up to $120 and then crash back to $80. And then there's a gap up and a drift up. Now, a gap up and a drift up are the ones that we want. These are the stocks that will open up 10%. Maybe it opens at $100. And then over the next 3 months, then it's going to go to $300. Just like in the examples that I showed you. Those were all gap ups and drifters. This is an example of a gap up and immediately crashed. So Meta here, which is Facebook, opened up around 7% of the day due to earnings and then crashed for the rest of the week. So this is one of the things that we don't want. And here is also another good example of a gap up with a fake move. So we can see Spotify on the day of earnings, it went out, faked me out, and then it crashed later during the day. So we can see the day is over here. Spotify, it gapped up around 10%. It went up during the day and then it just crashed for the rest of the time. And as you can see, it was not a good time to be inside the stock. And then the third type is a gap up and drift up, which is what I've shown you before, the one that we're really looking for. And an example could be Root. As we can see, the stock gaps up on earning. You can see the gap here, and then it goes all the way from $11 up to $83. And these are the stocks that can really move your account. You just need to get one of these. If you put $1,000 in this one, you would have around 8,000. So if you put in 10,000 in this one, you would have 80,000. And this would only happen in about 2 months. So these are the stocks that we really want to catch. But we don't know when they're going to come, so we always have to be alert. So as a trader, I always need to know 3 things to make money. The first is, how much risk should I take? Where can I know that this move is not going to make me money and I should just sell and take a loss? The second thing is that I should know when I should take a profit. What is the best time to sell so that I can always make the most money? What is my risk to reward ratio? And then the third is, I need to also know a probability that makes me profitable. So if I know that for every dollar that I risk, I'm likely to make $4, that means that even if I only win 3 times out of 10, I'm still going to be profitable. Because if I win 3 times out of 10, I'm going to win $12, which is 3 times 4. Then I will lose $7 on the losses, which is 7. And then the difference is $5. So I'm still going to be profitable. Now, if I win 5 times out of 10 with a risk to reward ratio of 1 to 4, I'm a golden boy. During my research, I tried to answer these questions so that we can all learn how to make money from this move. What were the results from my research? I did 2 types of research. I did a theoretical research where I did not use any money. So here I just studied the charts and I put a lot of data into Excel sheets. I actually took around 2,000 data points from these stocks. And then the second one is that after I finished doing that no money theoretical research, then I got some really exciting results, and then I had to take them and then actually implement them in the market to see if it works. And the results were amazing. So one thing about stock trading is that once you do a theoretical research, you want to actually check it out with very small amounts of money to make sure that it is profitable, because some things look good on paper, but they're just not viable in real life. Before I show you the results from my research, the first thing that I want you to know is traders have to think like a casino, because a casino does not know which bet is going to make money for them, but they do know that they're going to make money in the long run because the mathematical odds are just in their favor. So they know that their expected profit is the amount of money they're going to win every time times their probability of winning minus their risk the money that they're going to lose every time minus their probability of losing. So in simpler terms, as I'm going to show you later, is that a trader does not need to win every time to be profitable. Actually, even if you're only winning 30% of the time, you can be wildly profitable. So how can we think like a casino? So let's think of a stock. If we buy a stock at $100 and we know that $90 is our stop loss, so here we accept that the move is wrong and we must sell, that means that our risk is $10. And our potential profit, in case the stock is to go in our favor, we would sell it at $140. Our potential reward is $40. So this means that on winning trades, we take 40. On losing trades, we lose 10. That means our risk to reward ratio is 1:4. For every dollar that we risk, we can expect to get $4 back. And now this is where it becomes interesting, because it doesn't matter if you have $1,000 account and you're only risking maybe $10 per trade, or you have $1 million account where you're risking $1,000 per trade. Both of you are going to get the same risk to reward ratio. So knowing these things is going to help you no matter the size of your account. And also by winning 1-4, we don't have to win every time, as I'm going to show you how. Now, we have our picture over there. We have our risk to reward ratio. We know that it's 1-4. That means that if we have a 40% success rate, if we play 10 times and we only win 4 times, that means that we're going to win 4 times 4 minus 6 times 1, which is 10R. So 10R means we get 10 of our risks back. In this particular example, the risk is $1. If we have a 30% success rate, then we are going to get 3 times 4 minus 7 times 1, which is 5R. So even if we only win 3 times out of 10, we're still going to get 5 times our risk. So if our risk is $1,000, we get 5 times 1,000, which is $5,000. And if we only have a 20% success rate, that means that we will just actually break even. We will get 2 times 4 minus 8 times 1 to get 0R. That means we just break even. The maximum we could lose, I guess, is 0 minus the trading costs if they're available. So even if we win only 2 out of 10 times, that means that we are still not going to lose money. And this is where it becomes very interesting. Risk to reward ratio is just a way of knowing how much profit we are going to make for every amount that we risk. So risk of reward ratio of 1-4 means that for every dollar that we risk, we're going to get $4 back. And all traders need to think like this. They always need to think that how much am I risking and how much am I going to get back. So if our one risk is going to be 1% of our account, then it doesn't matter what size of the account we have. It could be $10 million, it could be $1 million, it could be 10,000. We're just always going to risk 1%. This is how trading is normalized for everyone. So if we win 3% and we have $1,000, then we're only going to win $30. If we win 3% with $1 million, then we're going to win a bigger amount. And another thing before I show you the results from my research is something that you must know is something called average true range. So this is a picture that I got online from one of the big banks trying to explain average true range, and I hope it can help you. So average true range is the average of the true ranges over a specified period of time. So what I mean is, if a stock is moving about $5 per day, that means that its average true range is $5. And most of the people use the average of the last 14 days. So that's why in this particular photo, you can see the ATR, average true range, and in the bracket has 14 to mean the average true range of the last 14 days. That's the average. This is an indicator that shows that when there are big bars and there's an increased volatility, the average true range increases. When there is a gap up in price, that means there is a huge volatility. The average true range also increases. This is a tool that I use to measure volatility, and it has nothing to do with predicting the price, but it helps me normalize my trades. Because if we measure the percentage of the move as a ratio of the average true range, then we get the real strength of the move. Because not all moves are created equal. Now, here we can see a 165% move, but it only gives us 11 risks back. I normally risk 1.5 times the average true range of the last 14 days. So here we can see that I would have risked 14% or $3 per trade, and I would have made $35 per share back. It's 165% move, but I only get 11 risks back. But here is another interesting thing. This other stock, which is EME, is less volatile. So it does only 65%, but it gives me a bigger return because I get 12 times my risk back in the same amount of moves. So this is why I use average true range, because it helps normalize the trade. Not all 100% moves are the same. If a stock does 100%, but its range is about 20% per day, then that's a very volatile stock, and that's not a nice 100%. But if a stock does 100% and it only moves about 1% a day, that means it's moving 100 times what it normally does, and that is a very strong move. Now here are the practical results from my research. So we can see that I took about 19 trades. When I'm doing my research, I like to do about 20 to 30 trades, and we can see that I managed to get a total profit of about $927. I have some notes. BT means bad trade. GT means good trade. OK means it was not that good, but it wasn't that bad. And the strategy was an earnings gap up. And we can see how much I risked over here. So my average risk was $34.5 per trade. If you were to look closely, you can see that I started out with smaller risks of about $15 and $30. But by the time I finished, because I was getting more confident in this play, I started to risk about $80. That's why I had much bigger profits. And as you can see, that was the total result. So took 19 trades, I got that result, that was my risk. And if you do the calculations, that means that for every trade that I take, I can expect 1.4 times my risk. And this is a way to put mathematics into our trading. That means that if I'm risking $100 per trade, I know that if I did 100 trades, I should expect each trade to just bring me about $144. And this can help us put some quantifying onto the chaos that is trading. So of course, as you become more confident, you can risk more. If you have a $1,000 account, of course, you have to risk a certain amount. If you have a $40,000 account, let's say you risked $200 for every trade in that particular research, you would have made $6,000 on average in over just 19 trades. And I did all of these trades in just about 3 weeks. I just say 1 month, but this is just to show you how profitable this strategy can be. And of course, as I got more confident, I increased my risk. So as a trader, why don't you want to lose money? Why do we talk about risk too much? Losing money is the hell of trading. As I showed you before, my goal is to make the most amount of money possible, but to lose very little when I lose money. And the reason why I want to lose very little is that risking or losing money works against us. So when you start to become profitable and you start to see that this strategy works, don't start risking everything. Don't lose your shit and then start risking your whole account, because losses work against you. So in this picture that I got online, of course, we can see that if we lose 5% of our trading money, we need 5% just to get back, which is okay. But if we lose 30% of our money, we need around 40% to get back, which is also close. But getting a 40% return is also hard, as you all know. But now what happens when we lose 50% of our money? If we lose 50% of our money, and let's say we had $100 and we drop to $50, that means we must double our account in order to go back to where we were. And you know how hard it is to double your account. So we must get 100% return to go back. If you lose 90%, you need to literally times 10 of the money. So let's not even talk about it. So here in this picture, I'm trying to show you what happens when you lose money. So the S&P didn't go anywhere for 13 years. That's why a lot of people, when you see them reporting returns about the S&P 500, they always say returns from 2010. Because that is, as you can see, that is where it started to go up again. But the fact is that from 2000, it just stayed around the same value. So when it lost a lot of its value, it went up, but it just kept failing. So for 13 years, nothing happened in the S&P 500. If you had put money in 2000 and you woke up in 2013, your account would just be the same. Now let's move on to the research. What questions did I try to answer in my research on this earnings gap up that will teach you how to be profitable as well? I was like, what did the biggest winners have in common? What did the biggest losers have in common? And what types of news created the best and repeated returns? And then how could we buy the gaps in such a profitable way? We have to ask ourselves, why do stocks normally gap up? Again, as I told you before, it could be biotech drug results. And I did not like this strategy because a few of the moves were great and many failed. So I failed to achieve a consistent results here, and I need to do more research there. Mergers and acquisitions, no consistent results did I find. Another reason why stocks gap up could be contracts, but I did not get consistent results because I'm not able to evaluate these contracts. I do not have enough knowledge on the companies. But the one which was very consistent was earnings news because it has a repeatable strategy, as I found out. So biotech drug news, I realized that these stocks can actually do 200 to 1000% moves in just a few weeks. And I realized that when it's an FDA approval or successful drug trial, this led to very huge and successful moves. But the stocks are very volatile. They could be swinging like 20% a day, which was too volatile for me. And sometimes I was stopped out several times because sometimes you have to re-enter a trade. And sometimes after you've lost on a trade 3 times, you just don't have the emotional energy to just try to go back on the same day. And there are also many gap ups and fakes. So I would need to do more research on this, but I also have limited time. And, when you have also many strategies in your stock account, it becomes hard to scan stocks. Managing your account is difficult, but I will later do some research on biotech drug news and I will bring that to you. Contracts and mergers, I did not really like this one. But the fact is that sometimes a company is being bought at $40 a share, but it's currently trading at $20 a share, which is literally a money glitch. Because if you bought it at 20, it's immediately going to be worth 40. But in practice, it's almost impossible to enter this trade because I looked really deep into the charts and I realized that these stocks will move up in price from $20 to $40 in just 1 minute. So unless you knew about this news before, it's almost impossible that you actually caught this move. And many times I didn't understand the valuation of the mergers. And also it's just news, so it's not predictable. I did not find a consistent pattern. But what about earnings news, which is the focus of this video? It's predictable. Companies have dates when they have to release earnings. I found a consistent pattern. It happens very often. A company must release their earnings 4 times every year. So out of the 10,000 companies, we have 40,000 chances per year, and that is a lot of chances. But what I didn't like, it's a bit hard to know when to add to your trade, and you must also scan for these stocks every morning. I'm a morning person, but I put this didn't like for some people are not morning people, so they don't like to wake up early, but you would have to scan stocks in the morning. I also tried to answer some other questions with the research. So is there a correlation between earnings surprise and subsequent move? An earnings surprise is the difference between what analysts are expecting and how the company actually performed. So I was like, is there a correlation between that and how the stock moved? And is there a correlation between the earnings per share growth or the revenue growth of the company for that quarter and the movement of the stock? And I found out some really interesting things which I'm going to show you later. I was also trying to wonder, when can I add to my position? Because great stock traders, when the stock is in their favor, always risk more money so that they can make more profit. And I was also wondering, where should my stop loss be so that I know that, hey, this move is not going to work. And then for the stocks that drifted up, what was the earnings per share growth or the revenue growth for that quarter? As we all know, EPS stands for earnings per share. And what did the biggest winners have in common? What did the biggest losers have in common? And for my research, each of my risk was 1.5 of the ATR. And I used the average true range of the day before the gap up. Of course, I used the ATR of the day before because the gap up day, since it has a very huge range and it could go up 40%, it normally skews the average true range. And then it just affects its value. So we use the day before. Buying is done at opening price for this research as well. What did I learn from the stocks that drifted up? These are the characteristics that I found. The median revenue growth for that quarter was 32%. The earnings per share growth for that quarter was 134%. The median earnings per share surprise, by how much percentage were the analysts surprised, was 48%. And the revenue surprise was just 4%. But then I realized that 90% of the stocks that drifted up after they gapped up were in a bullish industry. And I was like, you know what about those stocks that failed to move? What were their characteristics? They had a median revenue growth of 30%, which is the same as the other side. The EPS growth for that quarter was also 130%, which is very similar to the one that drifted up. The EPS surprise was 72%, which is just slightly higher than the other side. The revenue surprise, same. Now I was confused. But then I realized that 60% of the stocks that gapped up and then failed to move were in a bearish industry. And this turned out to be the most important part. So I came to the conclusion that gap ups and earning moves are just continuations of industry moves. When an industry is already moving, stocks in that industry are going to move. And if they happen to have earnings during that time, then things just all come together to make the stock move up. So when a stock is in a bullish industry, then it is likely to move. I realized that gap ups in an industry that is not bullish, they normally go up for a little bit and they just lead to nothing, as I'm going to show you. And then I even did more research and I was like, okay, so if the industry was just bullish, forget about everything in the stocks. What happened to the stocks that gapped up but were in a bullish industry? I realized that 73% of stocks that gapped up in a bullish industry then drifted up after earnings. And this was very interesting. This was despite their earnings or anything. The average return for holding the stock, as I showed you, was 4.5 risks per stock, which is really interesting. And then I realized that 80% of the stocks, never went more than 0.5 risks below the opening price. So it comes to the conclusion that a bullish industry was the greatest difference between winners and losers. And contrary to what I thought, it was not past earnings, it wasn't past revenue, and it wasn't return on equity. But I also realized that the earnings and revenue for that particular quarter seems to give us other clues. And I also found some extra characteristics of winning stocks. I realized that 80% of them never moved to 0.8 risks below their opening price. That means now we can know where to put our stop. I realized that 92% of them had super growth earnings, but I'm going to show you what super growth earnings are later. 90% of them were above 500 million in market cap, so just avoid the really cheap penny stocks. Those are more like gambling companies. They've not yet proven themselves, so just leave those alone. And the biggest thing that I also found is that many of the biggest winners that gapped up, they seem to have been dormant. They were in a huge consolidation where they were not doing anything, and then the news just surprised everybody and it just gapped out. So what is a super growth stock? These are my criteria because I've been a stock trader for some time and I already have other strategies that I'll share with you in other videos. This is my criteria for super growth stocks. These are stocks that are growing like crazy, and they must always have two of the traits below. They must either have a super earnings per share growth, a super revenue growth, or a super return on equity. So I'm looking for companies that are really selling things out of their mind. They're making huge profits. So a super return of equity is something which is 15% and above. That's for me. Super EPS growth is any one of the following. So it either has a quarterly growth year over year of 50% in the last 2 quarters, or it has a quarterly growth of 30% in the last 3 quarters. Now, of course, remembering all of these details is very hard. So I'm going to show you later how I have them in a chart. You just eyeball it and you can just know. You don't have to really think about all of these things. Just wait for that part. A super revenue growth is something that has 15%. Revenue has been growing 15% year over the last 4 quarters, or the last 2 quarters have been doing 20% year over year growth. So we can just eyeball our earnings table in TradingView. And if you see a stock that has 100% growth or 1000% growth, don't start thinking, man, just buy that thing. So here we can see that there is a table. This is an earnings table of a stock. This is AppLovin, which is app. So you can see the table over here. It has the year-over-year EPS growth, the revenue year-over-year growth, and then net margin, which we're not using currently. And then on this side, there is return on equity. So just go into TradingView. Let me use a weekly chart. Just go into TradingView. Yeah, so we have our table. We can see here a weekly chart. This is root, for example. So you can see the growth has been spectacular. We can look at NVDA. So if you just have this, you can just look here, return on equity is above 15, yeah. Then we can see here, is the revenue doing what we talked about? Is the earnings per share doing what we talked about? Yes, it's doing what we talked about. So this was a wonderful stock as well. So that's how you just eyeball, forget about all that theory. You just keep it in the back of your head. Just eyeball the charts and the numbers. It's already there. If you want to know the names of these indicators, just comment down below and I will let you know. So here we can also see another table of what I just showed you. Here we can see something that is not a super growth stock, and this is AMR. So you can see here earnings per share growth year over year. It's not going up. This thing is losing profits. The revenue is going down year over year. Although the return on equity is super growth, but it doesn't have 2 of the 3. So it must have 2 of the 3, but here it only has 1. So it is not a super growth stock. And what is a strong earnings report? It's an earnings report that shocks everyone and the company has abnormal growth for that year. Sometimes stocks have historically had bad earnings and then suddenly just shock everybody. So a good earnings report, which is a super earnings report, is something where the company has about 100%, earnings per share growth. Even if it's 80, I'll take it, or 100% in revenue growth for that quarter. So we can look at a stock called Seager. It had 9,000% EPS growth, earnings per share growth, and it had 900% revenue growth. And that's why it gapped up. If we look at its old earnings, they were horrible. But then once it gapped up on the earnings, where it gapped up, it had 9,000% in earnings per share year over year. That means that its earnings increased by, I think, 100. It went up 100 times. So it did 100 times what it normally does. That was crazy. Its revenue was also up times 10. So it went from like just 10 million to 160 million. And of course, those are just conditions for a stock to gap up. And as we can see, it did 66% in just 1 month. If you put in $10,000, you made your 7K, just like that in 1 month. And what is a bullish industry? So I'm going through all the criteria that the winning stocks had so that now you can know them in detail. Of course, in real time, this will just be very things that you can just eyeball. You always have to know the theory in order to get it right. So all stocks are part of an industry. And we must always make sure that their industry is in an uptrend. There are semiconductor stocks, there are clothing stocks like Lululemon. So we must always see that those stocks are in an industry that is bullish and is moving up. And I realized that TC2000 is the best for this. If you don't have TC2000, which is a stock screener, then you can just be using TradingView, where you can just look at the industry chart or the ETF of that sector. And then just think of that sector as a stock. And then you always want to see that industry in which the stock is in is at least about 20-day moving average, and the 20 moving average is moving up. So here in Powell, we can see that it's part of electrical products. That is the stock sector and its industry. And in TC2000, as I'm going to show you, okay, now this is a bad chart. Let me see. What can I use? Yeah, which one can I use? Okay, so here is Root, which is a stock. This is the industry chart up here, and this is the stock chart down here. So once it gaps up, you can see that the industry is above the 20-day moving average, and it is all sloping up. Don't worry about these indicators for now. But you can see that the industry is sloping up and it's doing well. And this big red candle that you see here was actually earnings as well. Why did it not go up on those earnings? It was because the industry was not bullish. Actually, it is this candle here. The industry was not bullish. You see, it was trending down. If we were to draw a line, the thing is just going down. And this is not a good time to be in the industry. So only, the stocks that gapped up, you remember what we talked about? 90% of them were in a bullish industry. So a bullish industry that is going up is the biggest catalyst for our huge return. So we can see also NVDA, actually recently, I also bought this one. It gapped up here on earnings. Look at the industry. So that's what we're looking for. So here we can see the industry chart. As I tried to show you, this is a stock chart, and The stock gaps up when the industry is bullish. So this side is a daily chart, this side is a 4-day chart. So if you don't have TC2000, just go into TradingView, look for the industry chart, or look at the ETF of that industry. So how do we actually buy our earnings gap? Now this is where we're getting into the details of buying. So we have our criteria. We all know by now it must be in a bullish industry. It must have great fundamentals. Like I showed you, it must be a super growth stock. Or if it was not a super growth stock, it must have a strong earnings report for that particular time. And I showed you what a strong earnings report was. And ideally, it should be coming out of a big consolidation or a big dormant state. So we want to see at least 1.5 months or 2 months of consolidation. That's when we can start to really trust these moves. Our stop loss is just 1 hour below the entry price. Our one risk is 1.5 times the average true range. And when the stock goes up, then we can put our stop below the low of the earnings day. Then we can use that as our stop loss. And then when can we add to a position? You can add a third to maybe a half of the original number of shares that you bought when the stock moves 1.5 hour to 2 hour in your favor. If you're a beginner, please abstain from adding to a position. Just don't do it. Just leave it to when at least you've gotten maybe 20 profitable trades and you're getting a good hang of this. When you're entering the trade, the first thing that you want to do is don't do anything for the first minute. Actually, I normally even wait for the first 5 minutes because I realize that a lot of these stocks that crash immediately, they do it in the first 5 minutes. So I wait for the first 5 minutes to finish normally, and then I buy at the high of the 5-minute candles. So this is just to avoid fake moves. So you can buy your first shares at the 1-minute highs or the 5-minute highs. So you don't need to go down in a time frame to be really direct. If the stock is going up and you can look at your clock, 1 minute has passed, just set an alert, at a slight price above where it's currently trading. And then, later in the day, if it hits that alert, then you can know, hey, this thing has passed where it passed. So you don't need to really go down in all the craziest details. I realized that many of the best stocks actually never moved below their opening price, or they moved very little against us. And if you've been stopped out, then you can re-enter. Don't be shy. Don't be heartbroken that you failed. If you've been stopped out, you can come back and try again, as I'll show you how I did it. I normally just try 2 to 3 times mostly, and after that, my spirit is crashed for that particular stock, so I just don't do it again. Here we can see how you can re-enter in case you're an impatient trader. So let's say you did not follow my rules. This is the 5-minute chart. I just went down into details just to explain to you. Maybe you did not follow my rules, you're impatient. First minute, 5 kind of formed, and then you didn't wait for it to form, you just bought in it. And then you got stopped out because you can see the next candle, stopped everybody out because it had it first went down and then it came back up. So you can re-enter here, for a profit. And then we can see that the thing actually did 40%, later in that same week. So let's say you're stopped out and you lost 3% of your $1,000, that was $30. You can come back and you're going to you had a possible profit of, should I say, $400. So don't give up. If you lose $30 just twice, you can still get a 40% move and then be wildly profitable. And then how can you exit on a profit? So I normally sell the first half of my shares when it has gone 3 risks or 5 risks from the entry. I normally sell the first half, and then I sell the second half when the stock violates the 10-day moving average. That means that it first closes below the 10-day moving average and then trades below the low of that day where it closed below the 10-day moving average. But my research showed that it's more profitable if you just hold and sell when it violates the 10-day moving average. You would actually make 50% money if you follow those rules instead of following the ones which I do follow. But the reason why I don't do that is because I'm impatient, and these trades that actually will move your account to just very far, I don't know when they're going to come. So I normally just choose the method that I showed you here and don't do this particular one. How much should you risk? I suggest just get 1/12 of your account and just buy with that. If your account is $12,000, just buy with $1,000 and then set the risk as where I showed you, and then you can be making some profit. Or if you're very mathematically attuned, then just get 0.003 of your account, and that's the amount that you should be willing to lose, 0.003 to 0.005. The reason why I'm saying you should, this is a bit of a conservative risk, but it's because there's so many opportunities like this, so you're able to compound your money over the year, but also there are many failing trades. So in this way, we will learn that when the stocks move against us, we don't lose a lot of our account. We'll only be losing a small percentage. But then if it moves in our favor, then we're going to be making huge profits. And as we become more confident, we shall be changing accordingly. What are the profit projections that I found? I realized that we will be in 3 scenarios when the stocks gap up. The first one is that it's gapping out of a huge consolidation. So this time I realized that it normally goes up on an average of about 5 risks to 7 risks from the gap up price. Sometimes the gap up is a continuation of a huge move and the stock was already in the middle of a move. Here I realized that the stock will normally go up 4 risks or 5 risks, or sometimes it's just out of a small base and it's just the base was only like 3 weeks or a month. So there you can just expect an average of about 3 risks. Now, of course, this is not something that always happens, but I realize that these are the averages that the stocks will move after the gap up. And of course, we can never know because, as I told you, we don't know the future. So, for example, Root did 75 times our risks. If you risked $200, you made $15,000 on this particular trade. Very huge skew. If you risked $1,000, you made $75,000 in a trade. That's how crazy it was. So here we can see a stock that's coming out of a big base. So this is APP, AppLovin. So we can see that it was resting for 5 months and it gaps up out of that huge consolidation. And then you can see it moves up just like that. And then we can see here, this is something called Comfort Systems. Actually, the ticker is called FIX. I remember this one. So you see it had a huge consolidation. Let's actually just go to the real map. So this side we have a 4-day chart and this side we have a daily chart. So we can see that here it was dormant for some time. Now it looks like it was just dormant here, but actually it's all this side from September. It goes down, and really if you look at the price at 190 from September to around January, which is over 6 months, it's really not going anywhere in price. So it has been dormant for a while. And it breaks out normally, of course, but then it gets earnings in the middle of its move. And this is what I was talking to you about. So the earnings is in the middle of a big move. So here we can expect just about 4 risks from the time that we enter. And I'll show you how I get those 4 risks. I have a table here that shows me with the 1.5 ATR, but that's just for the latest candle. But this indicator here that I made gives me the 1.5 ATR for that day. The day before was $10, so we can put 10. So we can see that this one went up about 5 risks. But I said you can expect about 4 to 5. After 4 to 5, it really just kind of sat there and didn't go anywhere. So how can you scan for these earnings gaps? So just scan for stocks that have gapped up in the morning. So there are 2 easy sites that I use. TradingView Scanner, this one is free, or a bar chart scanner. And another option is to sign up for my newsletter because I'll be sharing with you the top stocks that are likely to be going up. Of course, I'll be filtering them into the best that are likely to gap up and drift up. And I'll be emailing them in the morning so that you can just buy them when you wake up in the morning. Let's go through the TradingView Scanner. Let's see. Okay, so this is the scanner here. We can see I have my pre-market scanner. You want to make sure just do a pre-market change. I normally just do 5% and above. So here we can see which stocks going up 5% and above. Make sure that the volume is more than 200,000. Market cap is about 500 million. I just did 300 million because sometimes I'm looking for more stocks than are actually there. So that's how you can do that. Here we have a picture of that. There's also barchart.com. Just go there and barchart plus. Then there is just click pre-market trading and it will tell you which stocks have been going up pre-market, and it's also totally free. So what are the issues with these strategies? I realize that it can be overwhelming because some days there are over 10 stocks to buy, and sometimes you don't have the time or the money to buy 10 stocks. So you just have to choose 2 of the 10 stocks, and it's really hard. So, guidelines. Ideally, a stock should be from a big consolidation, should have been dormant. If it has already extended and it has already moved, then it's not a surprise. If you can check out the ticker of Dell in 2024, we can see what happened over there. What happened in Dell Technologies here, earnings, it just gapped down. It was not even a super growth stock, but you can see that it gapped down. There was no surprise. It has already moved in price. So many times the stock gaps up and reverses down in earnings. So what I mean is that sometimes the stock will gap up on earnings and then fail on that day, but then later it's going to come and recover. So for the stocks you've been watching and they fail in the morning, just put an alert, at the opening price, and then if it recovers, then you can come and buy it again. And also avoid trading in pre-market or after-market hours, because sometimes you're like, oh, the stock gapped up 5% in pre-market. Maybe I should just buy it now because it's going to be 10% in the morning. But I don't advise you, because there's just not enough participants in that market and it's hard to place stop orders. And all of these guidelines come from me being burnt. So I'm speaking from experience. I'm not making this shit up. And also avoid illiquid stocks. If it's having less than 200,000 shares, just don't enter that thing. So here in HIMS, we can see a picture. It has amazing earnings. I kept going. I call it HIMS and Hers. That's the name of the stock. And it's a gift that keeps on giving because it has two earning gaps that we can see. The first one is a nice gap up, but then the second one, it crashed on earnings here, as we can see. But then I bought it again, at around $13, $12 because it came and recovered, and the earnings were good and it recovered, and then it literally later went up 60% in 3 weeks. That's why I'm saying don't give up. So more guidelines, most charts are stable after 5 minutes. We've already talked about that. Some earnings will be slow on the earnings day, but then gap up and be active on the next day. So always use an alert to keep you on track. So HIMS and SELL, those companies can be a good reminder of that. 90% of winners were in bullish industries. I cannot stress this out. The reason why we repeat these things is that traders just keep want to try new things. But the reason these are guidelines is because we've tried and we've been burnt. So just focus on what works. Industry must be bullish and moving. Industry is the most important. And great earnings are great, but they're not as important as the industry. And of course, the biggest stocks come from the biggest bases. And these are always the beginnings of a new huge move. So let's go through our good examples. So we have SMCI in May 2023. Let's go to the chart. So here we can see that it was dormant for several months, SMCI. It really wasn't going anywhere. Like, it looks like it was going up and down. It was just consolidated. The price wasn't really moving. If you look at this price of $90 from December, the whole of December, January, February, March, April, for about 5 months. Really, if you look at the line, it's going nowhere. All of a sudden, it gaps up. This is a 10-day moving average that I told you that you can use as your selling guide. The thing did 200% in just 93 days. So everything is perfect. The return on equity was great. The earnings for that time were great. These are current earnings, but I can increase this table to show earnings from 2020. Let's say this was 2023. If you look at this table, you can see the 2023 earnings, because this is May, the period ended around March. So you can see around here, this time when it was doing 300%, 600% growth, this is when it gapped up. Because investors knew how much this thing was worth, That's why they're willing to bid for it. Currently, the thing is actually worth $1,000. That's why people were willing to pay all of these prices just to get in. Of course, next example is Powell, as I already went through. So you have to go through these examples so that you can really learn and stick it in your head and get it right. Look at the table. You can just see it's all greens, hundreds there. Return on equity is great. Gap up day is here. You can see on the 4-day chart, that's a gap up day. It was dormant from August to January. I don't even know how many months those are, but those are many months. Thing goes up 200% in just a few days. And this was sweet. So you can sell there. Okay, next one. Of course, it was in a bullish industry as well, as already talked about. So you have to always make sure that it's in a bullish industry. Root, I already showed you that this one is in a bullish industry. As you can see here, first thing is that it's in a bullish industry. Gap up day. So here it gaps up industry, chart is looking bullish. And we got trading view that I like to see from. See, it's the gap up day where we buy, goes up 600% in 2.5 months. That's times 7. Look at the earnings. They were great. They were not like super earnings, but remember I told you it must have 2 of them. So the earnings, it has at least they were 20% for 2 quarters. And you can see the EPS. It did not have a good return on equity. So that was a good entry. Next one, root themes. We've already gone through that, but we can repeat it just so that you can put it in your head. Okay, see, it failed on earnings, but earnings, the industry was going up for that time when it did earnings here. And also here, when it gapped up, we can see the huge gap up bar here. The industry was up. So if we come detailed into the chart, there's so many things that are going on here, but we can see that for the 2 of the consolidations, the stock was correcting for 2 months. So it has 2 consolidations. It has this one here, and it does have this one here. So it corrected for at least 2 months. Actually, this first gap up was even huger because you can see all of this time it was really not doing anything. Gaps up does 40% in a few days. Also here did 60%. Great historical move. And yeah, that is all. Thank you. I hope you've enjoyed this lesson. I really enjoyed teaching it to you. Please subscribe to the channel if you found value in this information, because it's taken me several years to come up to this conclusion, and I'm happy to share it with you for free so that we can all reach that financial freedom that we really want to reach. May the markets be with you.